Over the past 10 years, digital lenders like Tala, Branch, Okolea, Kuwazo Capital, and Zenka have transformed the credit market in Kenya and enabled more people to access loans through the convenience of their mobile phone. But before you sign another loan, here's what you need to understand about how these institutions determine your creditworthiness.
In digital lending, we use a similar process. The only difference is that the data we are using to determine risk is a lot. So we're using credit reference bureau data, we're using your transactional data, we're using your habits. So if you're an informal sector worker, we know how Boda Boda behaves. We know how an Uber driver behaves. We know how a Mamamboga behaves. And so we're able to then determine what industry you sort of guess what industry you're in. And then on top of that, figure out what limit you need. And then calculate the risk using those different metrics I talked, and then lend. So it's not so simple, but it's also not so hard. So the cost of capital plus the risk.
So how do these loans differ from the traditional ones extended by bricks and mortar financial institutions?
Typically, these products would have higher interest rates because the nature of the loan is unsecured. It is the customer journey is fully automated. So of course there are risks around identity fraud and things like those, and security issues. And so I have to spend quite a bit securing all that, and so it would typically cost more.
As Alan explains, digital lenders apply machine learning to understand the consumer's behavior and willingness to repay their loans.
You can look at, say, the apps you have on your phone, your call logs, your SMS logs, stuff like that would be able to give us, and all this information is towards building a profile for you. It's building to ascertain your behavior and how your behavior would relate to your creditworthiness.
Some lenders have up to 20,000 data points from a single mobile device. And thanks to the use of algorithms, many people who had previously been unable to access loans can today access them easily through their mobile phones.
A majority of our customers are in the micro-enterprise informal sector, so they've used the cash for business capital and operations.
In addition to checking your phone records, lenders add that having a good credit score is critical in determining your creditworthiness.
Keeping a good credit score with CRBs and repaying your loans is the biggest factor that would hurt your credit score. The other factor, things like keeping clean records. Yeah.
Because this business model is entirely based on an assumption determined by a machine, the higher risk is priced into the loan.
A machining system that makes the decision based on a myriad of factors, how much we think we can comfortably give you, and to what degree of certainty do we have that you're going to repay that loan.
Thankfully, digitizing credit risks has enabled lenders to make better decisions on who they are lending to and at what interest rate.
If I know you have a history of not paying your loans, why would I give you a loan? Yeah? If you've shown a pattern previously of borrowing and repaying your loans on time, doesn't matter the amount. In fact, even the amount now comes secondary. If you just have that pattern and that behavior of borrowing and repaying your loans, then I would be in a position to say, yes, this is a worthy borrower.
The amount you qualify for is informed by your creditworthiness as well as the history of borrowing. However, this is lender specific, with some lenders setting the threshold for the amounts extended to customers.
We also employ what is called risk-based pricing. So the lower your risk gets as a consumer, the better either the loan amounts you get become better, the tenor of those loans, the amount of time you have to repay becomes longer, and the interest rates become lower. So a combination of those three things happens.
Interest rates charged on mobile loans can be quite high, especially if you incur penalties for late payment fees.
We give on average 4,000 shillings per loan.
In addition to this, the customer is expected to cover the mobile money carrier fees when repaying the loan, and at least for some of the lenders. Let's have a look at some of these charges. M-Shwari charges a facility fee of 7.5% for a 30-day loan. Tala, a a fixed interest rate of 11% if you repay weekly and 15% if you pay monthly. Branch, the interest starts at 13.36% on the first loan, but gets lower as the loan amount increases. Zenka, charge a facility fee of 11% for a 30-day loan. With the industry cumulatively lending up to Kenya shillings 2 billion per month, concerns have been raised about the high annual percentage rate of these stopgap loans. However, the lenders argue that the APR is a wrong tool to gauge the true cost of these loans.
It's a bit misleading to use APR as the benchmark to evaluate digital credit.
The ease with which one can access a loan masks serious shortcomings. There appears there's little transparency on the implication of making late payments or defaulting on loans, and many borrowers end up with huge interest rate penalties, pushing some into defaulting.